and acquisitions. Right, so this is one of the main topics of corporate finance. So if you look at merger and acquisitions, essentially, what are these? Merger and acquisitions are basically investment decisions, right? Is that right? Merger and acquisitions are essentially investment decisions. Okay. So in the last week, I told you there are three main types of decisions that the company has to make from the perspective of corporate finance, right? What are those three main types of decisions? Number one, investment decisions. How do we make investment decisions? Using different project appraisal techniques, right? What are those? We call them capital budgeting techniques, right? NPV, right? IRR, payback period, right? And is there any another one? So I mean NPV, IRR, payback period, accounting rate of return, right? Okay. Good. So that's the investment decisions, right? So what I'm saying right now, the merger acquisitions are essentially investment decisions because you're investing into another company. You're trying to buy another company or acquire another company, right? So why would you invest in another company? If you believe that it will create value, right? Only then you will invest or acquire another company, right? Okay. If you believe that this is a project, this is an investment that has positive NPV, only then you should engage in such large investments. So in this session, we'll talk about merger and acquisitions. We'll define the terms. We'll look at the trends in merger and acquisitions. We'll look at the merger and acquisition process. And then we'll spend some amount of, a good amount of time talking about the sources of synergy and the motives of merger and acquisition. And lastly, I'll conclude the session in terms of our understanding of merger and acquisitions so far. Okay, so merger and acquisitions. So merger and acquisitions, as I just mentioned to you, these are essentially investment decisions whereby one company decides to acquire or take control of the assets of another company, right? So when you do project appraisal, you're basically evaluating a project, right? So here your project basically is acquiring another company, or acquiring the assets of another company, right? So you should see merger and acquisitions as an investment decision because these are essentially investment decisions. So what are the parties to a merger and acquisition transaction? There are two parties: a target company, which is being acquired or bought, and an acquirer, right? Or a bidding company, the company who is going to buy the target company. Okay. So the acquirer, because it's going to buy the other company, will have to pay a price, right? So the acquirer pays a price, which we call the acquisition price, to the target company, for the target company, to the target company shareholders, if it's a public limited company as well. Okay? So this acquisition price will have two elements. You will definitely have to pay the market price, whatever is the current value of that company, right? The price of, or the value of the target company. That's the minimum, right? You must pay the market value of the company, right? But normally when you make an acquisition, when you acquire another company, you offer some sort of premium. Okay? So acquisition price will be composed of two components: the market price of the company that you're acquiring, plus the premium that you're paying to acquire that company. Okay, so we call that acquisition premium. And this acquisition premium, on average, is substantial. It's between 20 to 30% above the target's share price. Okay, so 20 to 30% is, given the size of these transactions, it's a lot of money, right? Okay, so this is another way to show the same thing which I just said. So the price will consist of, acquisition price will consist of two components. Is this mine? What's happening to Teams? No, it's connected, right? Okay, let me just quickly plug in my charger as well. Okay, so what I just told you, the acquisition price will have you in acquisition price, you'll have to pay the current market value of the company or the current price of the company, plus you also pay some sort of premium. So the amount of premium, as I showed you, is a substantial amount. So if we look at it, so this is basically a graphical representation of the same thing. So we know there is a book value of equity. So what is book value of equity? That's shown in your statement of financial position. It's an accounting term, right? That represents shareholders' investment in the company, right? But we know that the book value is typically lower than the current market value of the company. The current market value represents the actual value of the company, right? So book values represent historic transactions, right? When the company issued shares, at what price they were issued, right? That's what's being recorded in the book value. But over time, if the company is doing well, company is generating more value, more return, right? So the market value of the company is typically higher, right? So we have at the bottom we have the book value of equity, then we have the market value of the company, and again if we talk about the market value of the target, right, which will be higher than the book value, and then so it's the market price that you would have to pay, but on top of it, the acquirer typically pays a premium, right? So the size of this premium would depend on other factors, mainly intangibles, right? For example, goodwill, right? So if you're paying someone above their market value, it's because some of it may not be reflective in the current market value. If you believe that the actual market value of the company is higher than the price at which it's trading, right? So you add that to the premium. So that's considered as the premium that you pay to the target shareholders. Okay, so this is the on the, if you look at it, look at the picture or the slide from the left. So we have a balance sheet value, then we have the market value, which is the current value or fair value of the company, right? And then you add a premium to it, which becomes the acquisition price. Okay, so this slide shows you the trends in merger and acquisitions. So it shows the number and value of merger and acquisitions worldwide between the periods 1985 and 2020. So what do you see in this graph? What are the things that you can see in this graph? So these blue bars represent the number of transactions, right? And the black line with dots represents the value of the transaction per year. Okay, so what do you see? Anyone? It's obvious, right? It's right in front of you. What do you see?
It's not, it's just like fluctuating.
Yeah, fluctuating what? Okay, so you see a lot of fluctuations over time, right? But broadly speaking, the number of transactions have increased over time, right? There are some, in some periods there are more transactions, in other periods there are less transactions, right? And the and where the number of transactions are higher, of course, the total market value of those transactions is also higher, right? So you see a lot of peaks and troughs in this slide, right? So you can see there are cycles, right? We call them merger and acquisition cycles. So before late 1990s, right? There were fewer merger and acquisitions. The value of those merger and acquisitions was also lower. But from mid 90s onwards, there was a big increase in merger and acquisition activity, and then it dropped after the dot-com bubble, which was in 2000 and 2001, right? So after that, it dropped, merger and acquisition activity dropped, and then it increased again, peaked just before the financial crisis, and in 2007-8 we had the financial crisis, 8-9, and then it dropped again, and then for some period it remained relatively lower or stable, and then it increased again in mid 2010s, between 2010 and 20. Okay, so you can see there is a lot of cyclicality here, right? And typically these go with the economic conditions. So you'll see a lot of merger and acquisition activity in booms when the market is growing, and when the market is not doing that well, then busts, the merger and acquisition activity drops down. Okay, good. So do you think this is a good way to invest? This is a good way to invest? Yes. Why? Sorry? Right. Okay. So when companies merge, they can bring the cost of it can bring the tax down, right? Or the cost of production, basically, right? You're saying tax, but it's mainly cost of production, right? It results in economies of scale, but that was not the question. The question was, so in this graph, okay, let me show you the other graph first, and then I'll ask this question again. The question basically was that in this slide, you can see merger and acquisition activity increases when there is an economic boom, right? When the market is growing, and when there is an economic downturn, then the merger and acquisition activity drops down. Okay. Okay. So this is data, worldwide data, and then this is data from the US for the same period. So again, you see a very similar picture, right? And here I have put the two graphs in parallel, right? So So these are like near mirror images, right? Okay, so you can see these are very similar graphs, right? In very similar periods there are peaks, and in many very similar periods there are troughs, right? Um, okay, good. Another thing is that a lot of this activity is mainly driven by US, right? So US is one of the largest economies in the world. So they have one of those. They have the largest corporations. So given the size, the value of the transactions are much greater given the size of the corporations. Okay, so the question that I asked you earlier. So we can see in booms when the market is up, when the market is high, right? When the market values are high, you see a lot of merger and acquisitions. And when there is an economic downturn, which means market values are typically lower, then you see less or fewer merger and acquisitions, right? Is this a good thing? What do you think? Is this trend normal? But I mean, that's what the data shows, right? If you are managers, right, you would do the same thing. Would you do the same thing? You will buy other companies when the values are higher, or will you buy other companies when their values are lower? Okay, so the common knowledge is that we should buy at lower prices, right? Right. So when there is an economic downturn, prices are lower, right? Then we should buy. And then when that's what we know, right? Buy at lower prices and sell at higher prices, right? But what we see here is when prices are higher, that's when a lot of transactions take place. So if you look at it from an NPV point of view, do you think these will turn out to be good transactions? Do you think these will turn out to be good transactions? Okay. Not sure, right? Okay. Okay. Good. All right. So let's move a bit forward, and then you'll have this answer, as we'll cover more material. Okay. But I got you thinking on this, right? There's a lot of activity when the market values are high, right? When there is uh, when the economy is doing good on average, right? When the market values are increasing, right? Okay. Good. So this is what we see. We call these merger waves, right? So there is a wave in late 1990s, and then there is a drop in that wave, and then another wave started in mid 2000s, right? Okay. So what do you see? Peaks of heavy activity followed by quiet troughs of few transactions in the takeover market. The greatest takeover activity took place between the 1960s, 80s, 90s, and 2000s. Okay, so the 1960s merger waves or merger acquisition waves are known as the conglomerate waves. So we'll define conglomerates as well. In 80s, we had the merger waves, which were mainly composed of hostile takeovers. In 1990s, the most of the acquisitions that took place were strategic in nature, and they had the global perspective, so it involved global deals, right? So which means your acquirer and target may be located in different jurisdictions. And in 2000s, most of the merger and acquisition activity is marked by consolidation in many industries, and the larger role played by private equity, because private equity gained a lot of momentum in the 2000s. Okay, so let's look at the types of merger and acquisitions. So here we have looked at some terms: conglomerate, hostile takeovers, strategic in nature, right? So merger acquisition activity could be friendly or it could be hostile. So what is a friendly merger or acquisition? When the management of two companies, right, mutually agree to combine their resources, right? So managers of the target company welcome the acquisition by an acquirer, right? So there may be a case where the target company is actually looking for a buyer, right? So we call these as friendly mergers, where the target is willing to sell to an acquirer or the highest bidder. Then we have the hostile takeovers. So in hostile takeovers, managers of the target company are not really happy with the acquisition. The acquirer approach the shareholders of the target firm as in a tender offer. So in a friendly takeover, the two managements agree on the product, right? But in a hostile takeover, the management of the target company does not see this acquisition as a good thing, right? So the acquirer, instead of dealing with the management, they make an offer to the shareholders directly. So if they can buy shares from the shareholders directly, then they get the ownership of the company, and then they can remove the management or change the management or do whatever they want, right? Once they have enough shares, that entitles them or that gives them the control of the company. Okay, so the acquirer offers a price higher than the market price in order to encourage shareholders of the target company to sell their shares. Okay, so the acquirer offers a price higher than the market price to get the 51% of the target firm's shares. Okay, so once they have more than 50% shares, then they can take control of the target company. Okay, so the mergers or acquisitions could be vertical, horizontal, and the third type is conglomerates. So what are vertical mergers? When you move up or down the supply chain. Okay? Vertical mergers are when you acquire either your supplier or your distributor, right? Okay, so you can see right in the middle, we have the manufacturer, let's say manufacturer. At the top, we have the supplier, and then at the bottom, we have the distributor or seller, right? So supplier supplies raw material to the manufacturer, manufacturer creates the finished good, right? And then there's the seller that sells that finished good. Okay? So if, for example, a manufacturer acquires a supplier, that would be vertical integration. That will give you control over the supplies. Or if a manufacturer acquires a distributor, that will give you control over your distribution channel, right? So that's what we call the vertical mergers or acquisitions. When you acquire either a supplier or a distributor. But it could work the other way as well. So for example, a supplier could also acquire a manufacturer as well, right? Okay, and then later on they can potentially acquire the distributor as well. Okay, so in terms of design, the firm operates at different stages of the supply chain or production chain. And as I already explained to you, for example, a manufacturer can acquire its supplier, and that gives you more control over the that allows you more control over the supply chain, right? Okay, what's the key objective of these vertical mergers? It strengthens the supply chain and reduces your dependence on other suppliers, right? Because by moving up or down the supply chain, you get greater control. So what's the result of these vertical mergers? So it reduces costs and wastages, right? So by taking control over your suppliers or your distribution channels, right? Or taking control over parts of the manufacturing process, right? You can cut your costs, right? You can reduce wastages. But the opposite effect can also take place, right? The opposite effect can also take place. Because if you, let's say, acquire one of your suppliers, right? So although it will give you more control over the resources, you will ensure that you get the supply on time, right? But because it will result in, it might result in less efficiencies in the long run. Because competition among suppliers can be beneficial for you as well. Because if there are multiple suppliers and they're competing against each other, then they can improve the quality of their product. They can price it more competitively as well. Okay, so it can work both ways. Okay, and then we have horizontal mergers, right? Horizontal mergers are within the same industry, right? So you move horizontally. What's the main reason to move horizontally? It would reduce your competition, right? And increase your market share. So basically, you are acquiring your competitor. By acquiring your competitor who is like in the same industry competing with you, right? If you acquire your competitor, it reduces the competition and increases your market power. So firms operate at the same stage of the production chain. For example, a firm acquires its direct competitor. So that's what we call the horizontal merger. It increases the size of the business, and there are benefits from economies of scale, right? Because the two businesses are in the same industry, right? They produce the similar kind of products or services. By combining resources, you become much larger firm and you benefit from economies of scale. What do we mean by economies of scale?
Sorry, it's the efficient balancing cost. If we reduce, then you produce more.
Right. So if you increase your output, cost per unit goes down. That's what we mean by economies of scale, right? If you produce a larger quantity, the average cost of production, the average cost per unit goes down, right? So it reduces your cost of production. Okay, so you get economies of scale due to horizontal mergers. It reduces the competition, which, as I mentioned earlier, increases the market share, and you get a greater control over the market. Okay, and then we have these conglomerates. So in conglomerates, they don't care about whether it's horizontal or vertical, right? So these are larger firms which own a variety of businesses. Those could be within the supply chain, right? Within the production chain, or those could be other businesses, right? Outside their main business as well. So firms operate in different production chains. So the key advantage of a conglomerate is that it results in diversification, right? So for example, a financial firm acquires, let's say, a car manufacturer, right? And then they may acquire a food producer, right? Or food processor. Right? So it results in diversification. So in a conglomerate, there are different businesses in different industries at different levels in the supply chain, right? So it results in a diversified firm, right? A firm that has different business units operating in different industries. So one key advantage of a conglomerate is that it improves the customer base. So given that you sell so much, right, to so many different Individuals, you have a large customer database, right? And you can customize your products. Okay, good. So this is kind of a summary slide, which covers some of the things that we have already talked about. So merger and acquisitions can be classified in the following way. So a firm can be acquired by another firm. If it's acquired by another firm, it can take the following forms. It can, so another firm, if one firm acquires another firm, it's called a merger. If the target firm becomes part of the acquirer, the approval of, and it requires the approval of at least 50% of shareholders of both firms, right? So if both firms, shareholders agree, mutually agree that they want to combine their resources, so that's what we call a merger, right? One firm combines resources with another firm, and shareholders of both companies agree to this, right? Majority shareholders of both companies agree to this. So that's a merger. Then we have consolidation, right? Where one firm acquires another firm, but in this case, the target firm and acquirer become a new firm. If the two firms combine resources, and as a result, they create a new firm, right? So that's what we call consolidation. Shareholders of both firms, in this case, will now receive shares of the new firm in exchange for their old shares. In exchange for shares of their old companies, right? Okay. Then we have tender offer, in which case the acquired firms makes a bid to buy a target firm, but in this case they approach directly to the target firm's shareholders, right? So acquirer buys shares directly from the target shareholders, bypassing the target's firm management. Target firm continues to exist if some shareholder would refuse to sell their shares, right? If the target, for example, if the acquirer does not get enough shares from target shareholders that give the acquirer the control of the firm, then the transaction would not go through, right? And that's why tender offers typically come with premiums to encourage the target shareholders to sell their shares at a higher price. Okay. So acquisition of assets of another firm. So acquirer buys the assets of another company in this case. So a formal vote by shareholders of the target firm is needed in order to sell some of the assets of the target to the acquirer. So a company, when a company buys another company, it can take these four forms: mergers, consolidation, tender offers, or acquisition of the assets of the target. And the other way is where the management of a company buys its own company, right? So if the company is acquired by its own management, we call it management buyout. Okay? So the target firm continues to exist, but in this case, as a private business. It is usually accomplished with a tender offer, right? Okay, so in this case, an acquired firm, a firm can be acquired by its own management. So let's say if I'm the manager of a company and all of you are shareholders, right? A management buyout would be that I buy shares from you guys, right? Okay, so if I buy more than 50% of the shares, I become the majority shareholder, right? Or I can buy all of the shareholders from everyone and then take the firm private. So that's what we call the management buyouts. Okay, so in merger waves, we have looked at, the data shows there's a lot of merger and acquisition activity when there is an economic upturn, right? When the market is booming. And the merger and acquisition activity drops when there is an economic downturn. So right in the beginning of this session, I told you that merger and acquisition are essentially investment transactions, right? So you should only buy another company if you believe that that it will result in creating more value, which we call positive NPV, right? In terms of capital budgeting, you should only invest into another firm if it results in positive NPV, if it's a positive NPV investment. But these, some of the investments may not always end up with positive NPV, right? So these merger acquisitions could be good, or so if they would be good if they add value, which means they have positive NPV. Or these could be bad. Bad ones would be those which would destroy firm value, right? Which means those would have negative NPV. Okay, so these could be good or bad or really, really bad, right? So this is an example of a good merger. So Exxon and Mobil, they merged together to create Exxon Mobil. You all know this, right? Yeah, you know this company, Exxon Mobil, right? No, some of you don't know. Okay. At the end of the session, go and look it up. All right. So the acquisition took place in 1990s. The merger value was $81 billion. $81 billion. How many zeros in a billion? 9, right? So you can see the scale of this just one transaction, right? $81 billion. Okay, and it's not in 2022. It's way back in 1990s, right? The revenue was $290 trillion. No, sorry, $290 billion, right? Because this is in millions of dollars, right? After the merger, revenue increased by nearly 19%. So your revenues increased by 19%, and your profits also increased, and the profits were $20 billion. Okay, so merger value was $81 billion, revenues increased by 19%, and profits were around $20 billion. So the total assets of this amounted to $346 billion. Okay, so you can see revenue increase, profit increase. It turned out to be a good merger. Okay, and then we had an example of bad merger, right? So here we have Daimler and Chrysler, right? So these merged together in 1998. So the merger value was $37 billion. As a result of this merger, there were no profits. Instead, there were losses of $2.7 billion. Revenue, instead of increasing, it dropped by 22%. Okay. So this transaction took place in 1998. It did not work out for the two companies, right? The merger did not work out. And at the end of 2007, there was a split again. The two companies broke up again, right? So and if you look at the value, the selling price, the selling value was only $7 billion. So initially bought at 37 billion, right? Transaction took place, merger took place at a value of 37 billion in 1998. And after like 10 years, is it 10 years? Roughly 10 years, 9-10 years, right? Instead of getting 37, and more, you only receive $7 billion, right? So you can see these can destroy a lot of value as well, right? So this is an example of a bad merger. But let's look at a really, really bad merger, right? So here we have AOL and Time Warner. So acquisition in 2000, merger value $111 billion. As a result of this merger, after the merger, it resulted in losses of $98 billion, right? The price change was negative 80%, which means the firm lost almost all of its value after the merger, right? Okay. And then again, just like the previous case, there was a breakup in 2009. Okay. And the selling value was only 36 billion. So from 111 billion in 2000, the value destroyed as a result of the merger. In 2009, in 9 years, the firm was worth only 36 billion from 111 billion. Right? So you can see how much value is destroyed by these mergers. Okay, good. Right, any questions so far? No?
Standard practice that before a measure for actually take place, there has to be due diligence between both companies. Very good. So I'm assuming there was due diligence before the measure. There was also results in it leading an measure. If due diligence was done. But due diligence is supposed to bring out issues for companies and also culture and operations. So if due diligence was done, the measure plan is great.
Okay, good. Very good question, right? Very good question. So the question is, in these two examples, we have seen that there's a lot of value that's been destroyed, right? But I mean, how could we let managers destroy this value, right? It's a lot of money, right? A lot of money, billions of dollars. So when you do a merger and acquisition transaction, there is a process to merger and acquisition, right? There must be firms are required to do due diligence, which means they look at all aspects of merger and acquisition transaction, right? In order to ensure that it will create value, right? Okay? So there is a process that needs to be followed. So if we see outcomes like this, what's our conclusion about due diligence process? That it didn't work out, right? The due diligence process wasn't good enough. It wasn't sufficient, right? So there were errors made, and these essentially all of these investment decisions are made by managers, which are like all of us are like humans, right? They're not like super individuals. They can make bad choices, and these examples show that managers do make bad choices as well. Okay. So there are errors that can take place in the merger and acquisition process, right? So in order to ensure that when you guys become managers, right, and you have to engage in merger and acquisition transactions, and you guys do not make the same mistakes that your predecessors have made, right? So that's why you're taking this class, right? So you know what's the process of merger and acquisition, right? You know what are the elements that you need to pay attention to, and then you make transactions that actually create value rather than ones that destroy firm value. Okay. Good. Right. So here we have the merger and acquisition process. It consists of 4 key steps. The very first step should be the should be strategic in nature, right? So what's the strategy of the firm, right? Why do you want to acquire, right? Why do you want to acquire? Develop an acquisition strategy. So set out a rationale and identify the resources required for the acquisition. So you can engage in merger and acquisition for a number of reasons. Can you name any of the reasons? Why do you want to acquire another firm? What could be the possible reasons to acquire another firm? Anyone? To get the market power, right? So if you acquire, let's say, your competitor, you gain more market share, right? You can potentially become the largest supplier of that product, for example, right? You gain a lot of market power. That's one reason. Any other reason? Reduce competition. Very good. Anyone else? Cost reduction. We talked about economies of scale, right? Anything else? Increase diversification. Very good. Okay. Increase diversification, right? Why do you want to increase? Why do you want to diversify? Improve customer base. But what's the key? Why do you diversify? What's the advantage of diversification?
To reduce the risks from.
Very good. The key reason why you diversify is because it reduces the risk, right? It reduces the risk. Okay. So what have we said? To gain, to reduce competition, to gain market power, right? What else? To achieve economies of scale and to diversify, right? Any other reason that you can think of? Not yet. Okay, but these are like you named 4 reasons, right? So for each reason, right? The objective is different. If, for example, you want to achieve economies of scale, right? Then you would have to identify targets that would allow you to achieve economies of scale, right? If, for example, you want to achieve reduce competition, for example, or achieve greater market power, then you would have to, your target should be one of your competitors, right? Okay, not moving upward. So the transaction must be horizontal in that case, right? So that's where you should start from. What is the strategy, right? Why do you want to engage in merger and acquisition transaction? Okay, and there should be a clear rationale, clear reason why you want to engage in such a transaction. Which, as we have seen, you guys have. I haven't told you any of these, but you guys have identified at least 4 reasons. Just write down. So each reason is a rationale for a transaction, right? So you need to identify what's your reason, what's your rationale to engage in merger and acquisition transaction. Okay, so once you have developed a strategy, then in accordance with that strategy, you need to identify the target firm. Okay, so choose a target based on firm strategy, right? As I was giving this example, if, for example, you want to reduce competition or gain more market power, then your target set is defined. You must buy one of your competitors, right? Okay. So you should choose an appropriate target that fits in with your strategy of merger and acquisition. Once you have identified the target, you need to value the target, right? So what is the value of the target? The firm that you want to acquire, how much you're willing to pay for it. So once you have identified the target, you know the value of the target, what you are going to offer, right? Then you have to decide about the payment structure, right? How you're going to pay for the target. So decide the acquisition premium and the type of the deal. So you have to decide how much premium you're going to offer, which again, partly linked to the earlier part when you establish the value of the firm, right? And then you have to structure your transaction. Are you going to pay for your acquisition by cash, or are you going to pay with equity? Or you can use a combination of the two, right? So you have to decide on the structure of the transaction. And within this structure of the transaction, depending upon how you decide to pay for it, you have to arrange finances for it, right? If you want to buy it with cash, do you have sufficient cash already, or do you need to raise more cash, right? Okay, good. So after the structure, the last step is to follow up to make sure that the acquisition results in the intended benefits of the transaction, right? We call it the follow up. Make sure that the acquisition is completed and is successful. It results in the desired benefits, right? Okay. So the acquisition process consists of these 4 stages. Okay. So let's talk about strategy, right? So I asked you this question, right? What are the possible reasons that may encourage you to acquire another firm? So if you look at the survey of CFOs, so this is based on this paper, Merger Motives and Target Valuation, a survey of evidence from CFOs. It's published in Journal of Applied Finance. So the authors carried out a survey of CFOs and asked them for the reasons for merger and acquisitions. So what's the number one reason identified by CFOs why they want to engage in merger and acquisition transactions, or the motive for merger and acquisitions? The number one reason is to take advantage of synergies. What do we mean by synergies? By combining resources, you add value, right? Okay. So the number one reason identified is that as a result of merger, they believe that it will add value, right? It will create positive synergies. So 37% of CFOs listed synergies as the number one reason. What's the next reason? To diversify. 29%, more than 29% of CFOs said that their main reason, the strategy to acquire another firm, the reason to acquire another firm is to diversify, right? Which is what you said as well, right? Okay. And then restructure the organizational form, which is much lower. The first two, you can see are much higher, like 37% and 29%. And then we have 10%, 8%, 5%, right? And then go restructure the organization form, acquire an undervalued firm, right? So if you look at this reason, acquire an undervalued firm. If, for example, I were the manager, right? I think this should be the number one reason, right? If you can identify a target that's undervalued, you can buy the undervalued firm, and if you buy undervalued firm, once market price is corrected, right, you will gain a lot, right? That's how we trade, right? Identify undervalued firms and then acquire those, create value as a result of the process, right? So this is essentially a positive NPV follow, right? But only 8% of CFOs list this, as their main motive of merger acquisitions. So reducing tax is another reason. Use excess free cash flows is another main reason. What does use excess free cash flows mean? What does use excess free cash flows mean? What does use excess free cash flows mean? Everyone's ready to review. Yeah, sure. Take your time. Okay. Take a seat, but it doesn't mean we don't have to listen, right? So use excess cash. So the data shows 5.3% of CFOs say that the reason they want to engage in merger and acquisition is because they want to use excess cash. Right? So what does this mean? External funds? There are no external funds, right? It means if a firm has a lot of cash, if they have a lot of cash, right? What are they going to do with that cash? One way to use that cash is to buy another firm.
They may launch the
No, it's the firm, right? There are no venture capitalists here. Okay? There are no venture capitalists here. This means the firm already has a lot of cash. What are they going to do with the cash, right? One use of that cash is to buy another firm. Use that cash to buy another firm, right? Okay, is that a good reason? Yes, that's a good reason. Why that's a good reason?
Because free cash flow managers will use free cash flow to invest in negative.
So that's a good reason. Go on, tell me.
If I'm the CFO, I have a lot of available cash. I can use the cash to do a lot of different activities. So I will do some investment, or I can repurchase the stocks, or of course I can different situation. We can do the best choice.
Okay. Okay, let's take one more time and louder so that everyone can hear, right?
Yeah. Okay. So if I'm a CFO in the firm, I have a lot of available cash. So I can do different strategies depends on different situation. Just as last class, the content I can do repurchase the stock back, and
So you can repurchase the stock back, right?
yeah, or I can do some investment. Investment.
Investment, which is like buying another firm, right?
Yeah.
Which is the question here, right?
Mm-hmm.
Okay. Guys, no talking, right? Okay, you choose no talking. Right. So the question. Okay. So if a firm, so what he just said, if a firm has a lot of cash, what are you going to do with the cash as a manager? If you have a lot of cash, and these 5.3% of these CFOs said, if they have a lot of cash, they are going to use that cash to buy another firm. And my question was, is that a good reason to buy another firm? Why? That's not a good reason, right?
Because all these transactions happen before you pay for your tax, so they could reduce the percentage of your tax.
No. So tax model reducing your tax liability is a good reason. But that's a different reason, right? That's not because you have excess cash. The reason you're buying the other firm is because you have a lot of cash. So, for example, if you look at the amount of cash that Apple has, the Apple firm, right? If you look at the amount of cash they have like billions of dollars, right? So they have a lot of cash. What are they going to do with it? That's the question. If you're a manager of a firm that has a lot of cash, right? So which means you can do whatever you want with that cash, right? So my question basically to you as managers, as future managers, is if you have a lot of cash, right? Will you consider buying another firm as a good use of that cash? The answer generally.
Sorry. I think it's not the motivation to access firms because we have excessive free cash. Because for the agents or the senior manager in the firm, they tend to improve the operation or successful performance of the firms rather than position or investment in the external market.
Good. So just because you have a lot of cash should not be a reason to buy another firm. Buying another firm should simply be based on positive NPV, right? As I told you, these are essentially NPV projects. If you can identify a target that will add value to the firm, then and you have cash, then it's fine. But generally, simply because you have a lot of cash and you're going to use that cash to buy a company, this is not a good reason, right? So there, from this, so last week we talked about signaling, right? From a signaling point of view, it is actually a good reason because once a company, so if a company buys another company, then it means those free cash flows would be reduced, right? So managers would have less chances to waste that cash elsewhere. But they could have actually wasted it in buying another firm, right? So the alternatives that we have as manager is to distribute that cash back to shareholders, either in the form of dividends or in the form of share repurchases, which is what you said, right? So that's a good use of cash. If you don't have good investment opportunities, right? If you can't identify a good target firms to acquire that will add value, then you should not. You should just return that excess cash back to shareholders. Okay, either in the form of dividends or in the form of share repurchases, right? Okay, if you return that cash back to shareholders, then shareholders can do whatever they want with it. If they want to invest, they invest. If they want to consume, they consume, right? So simply because you have a lot of cash should not be the reason to buy another firm. Okay, good. So let's go back to the second reason, second motive, which is diversify, right? Which is what you mentioned, right? So one of the main reasons, so it's ranked number 2, right? So it is a really important reason considered by CFOs. So they believe that diversification is a good reason to buy another firm, right? Because we know there is a benefit to diversification, and what is the benefit to diversification? That it reduces the risk of the firm, right? Okay. So diversification reduces the risk of the firm. So if you are a manager, right, would you use funds to diversify? Would you buy another firm to diversify? Yes or no? Yes or no? Okay, let me just put this in a question. Would you acquire another firm for diversification reasons? Okay, so you can use your app to vote for this, right? So again, go back to Vbox, right, and log in. So I'm spending a lot of time on this because once you go into market and you become managers, senior managers, right, you need to make these decisions, right? So you need to make sure what are the good reasons to engage in merger and acquisition activity. Okay, I'll give you like 10 seconds to log in and make a choice. You make your decision. You made your choice. You made your choice. Okay, how would you start? There's a spelling missing, right? Acquire spelling, okay? Would you acquire another firm or diversification reasons? No. There are two options, yes or no. We have to go with one. Okay? And then we'll talk about the two options, right? Can you make a choice? Okay, so, okay, allow me to make your choice, okay? Okay, so let's see what you're going to think. So you can make a choice, right? Because I wouldn't know who selected yes and who selected no. I would see the average results, right? Okay, so let's see. So good. So an overwhelming majority of you believe that diversification is a good reason to buy another firm, right? So 88%. 88% of you believe that diversification is a good reason to buy another firm. But in reality, that is not a good reason. Why? I'll tell you why. It's not a good reason to buy another firm. Because what's the objective of diversification? To reduce the risk of the firm, right? Okay. But who would benefit by reducing the risk of the firm? Investors or managers? Who would benefit from reducing the risk of the firm? The managers or investors? What's the reason? Okay, so think about this. I think I'll make it very, very simple. So think about this. If you are an investor, right, you can do diversification a lot better than the firm, right? Because as an investor, you can buy shares in multiple firms, which means you are diversified, right? So why would you want the firm to do diversification on your behalf? Because you can do it better, right? Firm, how many firms can a firm acquire? One firm, two firms? right? How many shares you can buy in different firms? You can buy shares in multiple firms, right? 20, 50, right? So which means as investors, you can do better diversification, right? If you can do better diversification, then there is no reason why you would expect managers or the firm to do diversification on your behalf, right? So if the firm engages in merger and acquisition transaction because of diversification reasons, that's not a good reason. That's good for managers because by diversifying, they reduce the variability in their earnings, right? So they can show, okay, their earnings are growing at a steady rate, right? The managers will benefit because they will be able to show better performance, more stable performance. But you as investors will not be better off, right? Because as an investor, the firm should not be diversifying. As an investor, you should be diversifying yourself because you can diversify based on your own risk tolerance. Some people like to take risk. They will buy shares of more risky firms. Some people are risk averse. They will buy shares of less risky firms. Some people want something in between, so they'll buy some shares of the risky firms, some shares of the less risky firms, right? So you can, as investors, you can do much better in diversification, right? So diversification, in reality, is not a good reason to buy another firm, acquire another firm. And given that we have seen these involves billions of dollars, right? And we have seen that they can destroy billions of dollars. Okay, so as if and let's relate this to the other reason which we talked about earlier, the free cash flows. Again, simply because you have free cash flows, managers should not engage in merger and acquisitions, right? If they have those free cash flows, they should return it back to shareholders so that they can do diversification themselves. All right? Okay, good. I hope it's clear. I spent a lot of time to emphasize these 2 points because I believe these are important for you, right? Okay, any questions? No? Good. All right. Okay, let's move forward then. Right. So going back to our acquisition process, so we have seen there are multiple reasons for which managers engage in merger and acquisition transactions. Not all of those reasons are good reasons, right? Okay. The only good reason to engage in merger and acquisition transaction is listed on the board. So you should only combine A and B if the combined value is greater than their individual values, right? If the sum of A and B is greater than A and B individually, that's the only good reason why managers should engage in merger and acquisition transaction. So the combined value of A and B is greater than their individual values because of these synergies. The increase in value is because of these synergies. So synergy implies that the combined firm will become more profitable and will grow faster, right? The generic term we use for it is synergy. So these synergies could be operational in nature, or these could be financial. So operating synergies allow firms to increase their operating income, okay, and or to increase their growth. So synergies would be operating in nature if, as a result of combination, your operating income increases, right? Or your revenues increase. Financial synergies allow the firm to achieve higher cash flows, or it would result in lower cost of capital. Okay, if as a result of combining resources, if it allows you to, let's say, borrow at a lower rate, right, that would be a source of financial synergy because it would reduce your average cost of capital. So synergies could be operational or these could be financial in nature. So this is something that I already covered in a lot of detail, right? So I'll go through this relatively quickly. So diversify to reduce the risk. This motive consists of reducing firm-specific risk by acquiring firms with asymmetric business cycles. This motive is, however, as I told you, is not a good reason, right, to acquire another firm. Individual shareholders could more effectively diversify across many traded businesses than firm acquiring a single target. So again, also as an individual investor, your transaction costs are much lower than if the firm acquires a target, right? So that's another reason why firms should not buy other firms simply because of diversification reasons. Transaction costs borne by individual shareholders are much, much lower than the premium paid to acquire the other firm. And also the due diligence process is costly for the firm. So this motive might work for private companies held by one or few owners, right? So if it's a private company which has like one or few owners, so they can potentially use diversification as a reason to engage in merger and acquisition transactions. So for example, family-owned businesses diversify their risk by acquiring other businesses. So for private businesses or smaller businesses, this can be a good reason, but for larger firms, public limited companies, this is not a good reason. Okay, good. So in terms of organizational restructuring, this motive consists of taking over poorly managed firms. So this is valid when the poor performance of the target firm is mainly due to incumbent management. If the current management isn't doing a good job in managing the firm, right, as a result, they will be undervalued, right? So if you take over the business, manage it better, then you add value by replacing the poor management or bad management, okay? So this will add value. The acquisition is followed by a change in managerial practices to better ones. So the acquisition announcement does not push the market price up too high before it's completed. So in such a case, so the increase in value will take place after the event. Once the company is being acquired, the new management has in place the old management, improve the management practices, and as a result, the market value of the target company of the new company will go up, right? So acquiring undervalued firms. So this is similar to arbitrage. So acquirers target firms which are undervalued by markets to exploit any mispricing. So this strategy is only successful when the acquirer is able to identify the undervalued firms. So the only way you're able to identify an undervalued firm is when you have access to superior information. So access to better information and having the ability and tools to analyze that information better, right, than the other market participants. Only in that case you will be able to identify undervalued or overvalued firms. So the first point in this case is you should be able to identify undervalued firms. Once you identify undervalued firms, you should have the resources to buy those undervalued firms, right? You should have access to enough funds so that you can complete the acquisition. And lastly, you need to have the skills in execution. The acquirer should avoid driving the target share price up by offering a much higher premium during the process. Because if you do offer a higher premium, then by offering a higher premium, you might eliminate all of the undervaluation in the process. And by offering a higher premium, if you eliminate the undervaluation, then you will end up with nothing, right? Okay. So you need to be careful in executing the strategy so that you offer a premium, but that's not high enough to eliminate all of the undervaluation, because it's the residual that you will capture.